Good morning, everybody. I'm so happy that everyone is here. Today is the kickoff of our Equity Week Training Summit series. We've decided this year that we're going to do a series of training sessions. So we're going to shoot to have one a quarter, this being our first one. I think the next one probably will be in July and so forth. We're really excited to have a subject matter expert here with us today. And he's going to be fantastic in sharing information that we hope will help you in your business development and sustainability. So here is Zachary Knox Esquire. He's been a practicing attorney in the cannabis industry for 12 years. He is co-founder and a managing partner of the Knox and Ross Law Group, which was established in 2012. Mr. Knox is intimately familiar with the California cannabis industry and is nationally recognized as an expert in the field of cannabis law and regulation. Mr. Knox previously served at the City of Oakland's Cannabis Regulatory Commission, and his firm, the Knox and Ross Law Group, has been the contract legal services provider for several of the cannabis technical assistance programs across California. And he is one of our experts for the Department of Cannabis Regulation, and he has been for the last 3 years. Mr. Knox is dedicated and committed to equity, and as evidenced by his continued work to support and improve cannabis equity programs, as well as his work with other equity support organizations, such as the Cannabis Health Equity Movement and the Alliance, Inc. It's a California nonprofit organization focused on providing education and training resources to underserved communities. So with that, I will turn it over to Zach, and just some housekeeping. We're recording this, so for folks who weren't able to join us can hear this. So please, be quiet and be respectful of the recording. And we hope that you learn a lot today and take away information that is relevant to your business. I'm Dr. Brown. I'm the Social Equity Program Director for the Department of Cannabis Regulation, and we're so happy to be here, and welcome. Thanks.
Thank you, Dr. Brown, for that wonderful introduction. Okay, a couple of housekeeping notes before I get started. We're going to do a couple of presentations this morning. The first one, as you can see on the screen, is going to be about structuring your cannabis business to attract investment. After that presentation, we'll be taking a short break, and then I'll be following up with a second presentation on intellectual property protection in the cannabis industry. But before I get started, can we, by a show of hands, can you let me know how many of you are in the cannabis industry already? Okay, quite a few of you. And how many of you are not in it yet, but are considering starting your own business in this industry? Okay. And for those of you that are in the industry, by show of hands, are you already branding your business? Okay. And are you already talking to prospective investors about investment in your business? Okay. It looks like there's a couple of you here. These presentations are going to be very important for both of those situations. Okay. We're going to start with structuring your cannabis business to attract investment. I have to start with this disclaimer. This presentation is for informational purposes only. I strongly recommend that you seek private counsel before you execute any agreements around capital formation or around intellectual property sharing, okay? The City of Los Angeles and the DCR has a very excellent pro bono, low bono legal services program going on down here, and I would strongly recommend that you take advantage of that resource as you move further into these discussions. I don't know who this guy is, but I had a very nice introduction from Dr. Brown. So we'll go ahead and move on and get to the meat of what we're going to talk about here. So this first presentation, we're going to talk about how to structure your cannabis business to attract investment. Now, I want to be clear that we're talking about capital structuring here, not your entity structure. So this is not the presentation where we're going to talk about whether you should be a corporation or an LLC or something else. There are other presentations that we've done in the past that are accessible to you from the DCR's learning management system where we talk about those things. Just to give it to you in short, if you are starting up, you should be a corporation or an LLC, but that's not the focus of the presentation today. The presentation today, we are talking about bringing in the money. And you may be aware that as this industry matures, as sort of the excitement has died down, the money has been much harder to come by. If you had started in 2018, or if you've talked to other operators who started as early as 2018, you may have heard stories about how free and loose the money came. The capital markets in this industry have dried up since then, and it is really much more difficult to raise the capital that you need. So in this presentation, we're going to talk about capital funding. We're going to talk about the different sources of capital where you may go to try to find money, how you want to structure your capital, and then we'll talk about some alternative approaches to raising money, and some of the things that you should watch out for, because there are sharks in the water. There are predators out there that will take advantage of you. And so we're going to talk about some of the telltale signs, whether or not the investor that you're talking to may have predatory behavior in mind. So why raise capital, right? Some people think they can come in and bootstrap this business or get some sales going and sort of work off their revenue. I would say that from new entrepreneurs coming into this industry to even more seasoned entrepreneurs coming into this industry, almost nobody has a full appreciation for exactly how much capital is required. It is almost always underestimated. I like to joke that all of you thought you were getting into the cannabis industry, but what you're really getting into is the compliance industry. And that compliance expense is going to be a premium on everything else that you need to fund in this business. Okay? You're going to need money for execution. Equity qualified individuals are under-resourced by definition. Capital partners may try to use that against you. You want to be able to leverage other people's money for the success of your business. You want to dilute the risk of any investment that does come in. And raising capital can also be used to get commitments from key partners, lead customers. It can give you access to much needed expertise, help you attract key employees. I'm sure the DCR will be talking to each of you about their hiring program. What you'll find out in the cannabis industry is that you may be able to hire people, but retaining them and keeping them is another challenge, right? A lot of these businesses will poach employees from each other, right? So if you have a strong capital foundation, then you can make the sort of job offers to your employees and provide them the sorts of benefits that may keep them from jumping ship to the next operator. And then obviously, if you're able to raise capital, that does give your business some credibility. Somebody has looked at your operation and your proposal and said, yes, I will put money into that. That's credibility that you can't buy, okay? So these are all the different reasons why we should be thinking about raising capital as we get our businesses started. And so let's get into some of the mechanics of it. All right, so capital and capital funding. First, what is capital? What do I mean when I say capital? I don't mean Sacramento, the capital of California, or Washington, D.C. I'm talking about money, largely. But that's not the only thing, right? So by definition, capital is anything that can be beneficial or of value to the business. If you're a manufacturer, by show of hands, how many of you are getting into manufacturing? Okay, so quite a few of you. A partner who is willing to come and put equipment into your business. is contributing a form of capital. If someone has a proprietary recipe that they want to contribute to the business, that is a form of capital. We most often think of capital as money, but it's really anything of value, right? So not only does the business need capital, right, but we need to talk about how that capital comes in and what form it comes in with, right? So we're going to talk largely about capital funding. So this is bringing actual liquid capital, money into the business. And capital funding is money that lenders and equity holders provide to the business so that it can launch and maintain its operations. So where does the capital come from? There are some sources of capital up here on the screen right now. Not all of them are going to be available to you in the cannabis industry, right? It's going to be very hard to walk into, say, Wells Fargo and get a traditional bank loan for the cannabis industry. But that doesn't mean that there aren't sources out there, right? So if you can establish business credit, if you can factor your invoices, if you have personal savings that you want to contribute, if you have family or friends, I always talk about the 3 F's, family, friends, and fools who might contribute to the business, right? There are government grants that are available. This has been a really significant change for equity businesses now that grants are available for some of these programs. And then there's, additional investment capital, which is represented by the venture capital here. Most of these cannabis businesses will not be venture capital eligible, but that doesn't mean that you can't attract some angel investors who may have venture capital in their background. What I want to make clear to you is that there are a number of different places that you can go to look for capital, and you should be looking into all of them. You don't want to give any single investor or investment group necessarily the entire piece of the pie unless that really is the right deal for you, right? You will create more value in your business if you can bring in capital from multiple different sources. So let's talk about equity capital and debt capital specifically. I bring these two sources up because this is the most common way that cannabis businesses get capitalized, all right? So what are some of the equity capital sources? Your friends and family, convertible notes that we'll talk about later, angel investors, right? And corporate and joint venture partners, right? Debt capital, on the other hand, will usually come from private lenders, existing partners who may have already put in equity capital and now they're willing to make more capital available in the form of debt, government loans, if those are available, and occasionally you can get an institutional lender. Those are more challenging to come by in this industry, but there are some banking alternatives that cater to this industry, and a lot of them are starting to introduce lending arms, okay? So equity capital, debt capital are going to be the primary ways that you can bring capital into your business. So let's talk about each of these in turn. What is debt capital? Well, debt capital or debt financing is when a company raises money by selling debt, okay? A lender would make capital available to the business, and what they're making that capital available for is on your promise to repay it. Repay the principal, usually plus interest, right? Just like traditional lending. They'll loan you money, they want that money paid back, and they want interest tacked on. That interest is their return, okay? Examples of this are promissory notes, some other types of debt instruments. And for those of you who have already started your businesses and have started talking to investors, you're going to see this come up. They are going to propose, at least on the outset, that their investment comes in as debt. They're going to want that debt paid back, and typically they're going to want some sort of return on top of that debt, and that is the interest that we mentioned to you before. Now, traditionally, debt capital is non-dilutive. Now, what I mean by non-dilutive is bringing in that money does not reduce your ownership stake in the business. Okay? Equity capital, on the other hand, is dilutive. And so before I move on to equity capital, let me just put one thought into your brain. The city of Los Angeles and the DCR has promulgated rules about what your minimum ownership interest should be in these businesses. I want to emphasize that that is your minimum ownership stake. For those who have started a business, for those who are thinking about starting a business, if you have not taken on partners yet, I want to emphasize that you own 100% of your business. And if you're required to maintain 51%, believe me, the partner is going to come in and ask you for 49 out the gate. Right? Don't just jump and accept giving away 49% of your business because you know that you have to maintain 51. You are in control of your business. You own 100% of it. And any percentage that you give up, whether it's 1% all the way up to the max, it needs to be justified. It needs to be value-based. The deal needs to make sense. And all too often have I seen equity operators give up a big chunk of their business for what turns out to be not enough money to get things started. It might be a significant amount of money. Somebody could put in $500,000, right? But if that's not enough to get you to the finish line, you might want to think twice about giving up 49% for that $500,000. This is about getting to the finish line. It's not about getting started. You need to get your business open, the doors open and operating. And if you have already given up the max amount of equity that you can give up in your first financing deal, there is going to be very little room for you to bring additional funding in that you might need to get across that finish line. Okay? So, what are the pros and cons of debt capital? Remember, this is non-dilutive. This does not impact your ownership traditionally. The good news is that it's other people's money, right? And that you're not losing any ownership interest on an account. The flip side to that is that now you have a debt that needs to be serviced. And most loans require periodic payments, whether it's monthly, whether it's quarterly. If you do accept a debt deal, I would strongly suggest that you negotiate for repayment to start sometime after you have gotten the doors open. It can be very difficult if repayment starts before then, because now you are draining whatever resources that you have in savings, right? So if you get, let's say, $100,000 in as a debt, and it goes into repayment right away before your doors even open, understand that that is going to reduce your resources over time. And when it comes time to open your doors, you're going to have less capital to do it with. So we have to think about when repayment starts. We have to think about how we're going to service debt if we're accepting debt, because it will be a significant strain on your cash flow. The other challenge with debt is that your lender's interests may not align with your interests. Remember, in every scenario, your interest here is to get your business open and to get your business operating. A lender's interest is in getting paid back. And those two things don't always align up well, right? For example, as I just mentioned about the periodic payments and when repayment should start, a lender may feel pressure to bring those payments in right away to justify their lending decision. At the same time, you're going to be negotiating for a delay or what we call a deferral of that repayment until you have cash flow coming in. So there may not be good alignment between your needs and the lender's needs. And so those are considerations that we need to think about when we are being presented with debt deals. So let's talk about equity capital. Equity capital is dilutive. We'll talk more about that. But this is where an investor is purchasing a piece of your business. If you're a corporation, they're buying your stock. If you're an LLC, they are buying your limited liability company membership interests. They are buying into your business. Traditionally, there is no obligation to pay back equity. We'll talk about how that sort of changes in this industry. But traditionally, there is no obligation to pay back equity investment. When somebody is making an equity investment, their return is the value of that investment growing. That is the upside that they're looking for. If you think about traditional stock investing, you're hoping to buy low and sell high, right? Not every company is paying a dividend. There is no obligation to pay dividends unless they confer that right to you, right? What you're hoping when you buy that stock is that that stock increases in value. And then you recognize that increase in value when you turn around and sell it. That's the exit, right? And so traditionally, equity investors are concerned about the exit. That's when they should be realizing their value. They have bought into the company has increased in value, and then either they sell their interest or the company gets sold, and that is where they make their money. Okay? What are some of the pros and cons of equity capital? Well, there's no periodic payments, right? You don't have a repayment schedule. The goals of the founders and the investors are often in alignment. We just talked about how lenders and debt financing may have a different set of priorities from you. Typically, your equity investors and you as a founder are aligned in your priorities. You want to see the company successful. You want to see the company increase in value. In the investor's mind, that increase in value translates to capital gains. Because they're waiting for the company to increase in value, they often typically have a longer time horizon. A lender, even if they are willing to work with you and defer some of the lending payments, don't be surprised if they want you to start repayment in a year, in 18 months. An equity investor traditionally has a longer time horizon. Those are the pros. What are the cons of an equity investment? Well, there is dilution. I've told each of you that when you start out, you own 100% of your business. When you start selling equity, that number is going to go down. Now, you can't go down below 51% here in Los Angeles, but you will go down from 100. And everyone in this room should be comfortable with that. Okay, this is how we capitalize our businesses. We're not going to be talking about issues of control here today. with a 51% ownership stake, you have a voting majority. You should have control. That's not the issue here today. But you do need to think about, how much am I willing to give up, not to remain in compliance, but for the amount of investment that's being offered. Okay? The amount of investment on any particular deal should be taken into consideration against the relative value of your business. So we'll just do some quick and dirty math. I'm an attorney, not a math major, so forgive me, but I like to keep it simple. If you're projecting your business to be worth $1 million and somebody is offering $100,000 of investment, that's 10%. Rule of thumb, 10%. Okay? I don't care that they think that they're the only investor out there for you and therefore they should get 49%. You have to resist that pressure. They are going to ask for it. Let me digress just for a second, because we have a lot of equity operators in the room, and all of you need to understand this, because what the predators do in this industry is they'll offer you a bad deal. And when you say no, they will tell you, well, I'll just go to the next equity operator. And they'll keep going until they find somebody who'll say yes. They'll keep asking different equity operators until somebody is willing to take that bad deal, either because they don't know any better, or they're not taking advantage of the legal resources that the city is making available to you. Or maybe they're offered, just a cash out right now. Hey, you give me $25,000 right now, cash in my pocket, you do whatever you want. It is hard. It is going to be hard for you to get honest deals if there's somebody else in this program willing to take a bad deal. So it's important that everybody gets some of this information, that everybody knows what to look out for in terms of predatory behavior, and everybody has a healthy perspective about equity financing and debt financing. So what are some of the other cons about equity capital? When you are the only one owning your business, you don't answer to anybody. That changes once you bring on partners, right? You may now have a board of directors that you have to answer to if you bring on partners. You may have if you sit on the board, you may have investors that you now have to answer to, even though you're a director of the business. So what was once essentially yours to control outright, once you start bringing in partners, they will have some say, and you will have to answer to them about the decisions that you make regarding the business. And the last point, I may have mentioned this earlier, but once you bring on equity capital partners, the focus does shift to what is the exit strategy. For those of you who are in the room who have already started a business, maybe already had conversations with potential investors, they may be talking about quote unquote roll-up strategies. They may be talking about buyout clauses. They may be talking about, we're going to run this business for the next 3 years and then we're going to look to sell it to one of these MSOs. By MSO, I mean multi-state operators, one of the bigger operators. Okay? Like the lender, your equity investor wants to know how they're going to get paid. This is an essential part of any pitch, any presentation that you make to prospective investors for equity capital. So for those of you who are already developing your investment thesis, who are already developing your capital strategy and identifying who you might want to pitch your opportunity to, you need to have a conversation about the exit strategy. The investor needs to know how they're going to get paid even if it's a longer time horizon, even if the payments are not guaranteed, right? This is going to be about selling your opportunity to those investors. So the focus does shift somewhat. There's still alignment, company success, capital gains, but there will be a shift in focus to how do the investors exit. And heck, maybe some of you also want to think about, how do I exit? Right? Unless you're in this for the long haul. Maybe you're true believers and you see yourselves in the cannabis business for the next 20, 30 years. But some of you, I think, are going to build these businesses up, take a look at the good work that you've done, the value that you've created, and will be happy to take your money off the table.